Right? It's not just one application. It's not just a chatbot that you can put on your website and have talk to your customers, which is a very cool application, by the way. But many customers, if they stop there, they're not going to get the true value out of what this technology is bringing to them. We want a set of services that'll help customers be able to build guardrails so they can build safe applications, combine multiple models together, where it's not just one model that's going to give them the best performance. It's going to be sometimes a small model and a big model and a variety of different providers that are bringing models together. Its capabilities like associating it with your enterprise data and a RAG index so that you can make sure that you have sources of truth when you're trying to answer questions.
More breaking news on Amazon. Let's get back to Kate Rooney. Kate.
Hey, Morgan. So Amazon's founder and former CEO Jeff Bezos plans to sell another 0.5 million shares. That's according to, or $1 million worth of shares. That's the dollar amount, according to a regulatory filing that just came out. It comes after Bezos filed last week, saying that he planned to sell another $25 million worth of shares, or 25 million shares worth roughly $5 billion. Amazon's last filing indicated that Bezos had adopted what's known as a 10b5-1 plan, a stock sale plan that allows him to sell these shares through the end of 2025. Bezos has been funding some private endeavors like Blue Origin, for example. He's also been giving shares.
Now let's get another check on Amazon. Those shares are down about 4% after reporting weaker than expected revenue for the second quarter. Joining us now is Scott Devitt from Wedbush. Scott, they did face a $1 billion currency headwind on the top line here. I don't know how much of that was factored in from the beginning. And AWS, a little better than expected. So what do you think of this reaction? Good quarter, mediocre quarter?
Dean, let me begin with you. It would seem to me that after this CPI report, this inflation report today, the story is already written. There's going to be a rate cut in September. Has the market already priced that in?
The market has priced in a rate cut in September. The market's really trying to distinguish whether it's going to be 25 or 50 basis points on the size of that rate cut. I think the only thing that could throw it off would be, if we just get a horrible inflation print right before the meeting. But that seems unlikely given the backdrop that we're seeing in the inflation numbers now.
With all the hype around AI, Amazon has spent about $30 billion year to date on AI infrastructure and other server infrastructure for the AWS business. Amazon is planning to spend another $35 billion for the rest of the year. Amazon is seeing growth in their AWS business, and their margin up to this quarter is up 35%. Clearly, Amazon is benefiting from the AI growth in the tech sector. In this video, we will examine the earnings and the growth of the stock, and we will talk about whether it's a good or a buy. If you like this kind of content, please remember to subscribe and add your comments on what you think about the Amazon stock. Also, in the link in the description, you'll find some of our research on Amazon stock and their earning calls.
So yeah, on my side, what I would say about Amazon is a great company, right? Because this is how you have to think of Amazon. They have a huge part of their business which is driven by e-commerce. And 5 years ago, e-commerce was like the AI. 5 years ago, when COVID happened, everything e-commerce was just booming. So a majority of their business is focused on everything that's e-commerce related, and that's, I believe, 80% of their business in terms of revenue. And then the rest, which is around 18% of their business, is focused on AI. So they have two major drivers for their growth. And that's all you have to know about Amazon to kind of be very, very enthusiastic about the company itself. I don't know if you want to add anything. I have some financial things that I wanted to dive into, but yeah.
Yeah, so Amazon, though the biggest part of their business is e-commerce, and they also bought Whole Foods, which is their retail business. Most of the money they make, or the operating income or net income they make, is coming from the cloud and data center business, which is AWS, Amazon Web Services. And whenever they improve margin in that business, then the business as a whole does well, basically. I think this is one of the stock that a lot of investors are kind of playing down a little bit because they are seeing a little bit of weakness in customer spending Amazon platform as far as the retail business and the e-commerce business are concerned. But AI is kind of helping them grow their margin, and we'll dig a little bit into that, but that's kind of the bulk of the situation.
I would say I agree and disagree, but hopefully the figures will show that. Just a second. I hope you can see my screen. This is Amazon's revenue for the past 5 quarters, and as you said, there is a growth year on year in terms of the quarter two is growing 10-11%, going from 134 billion to 148 billion, which is quite big. And on the right side, you can see that most of the business, 61%, is everything retail or kind of e-commerce driven, which is 61% of the revenue coming from North America, and then a little bit coming from international. And we have the AWS business, which is only 18%. So in terms of like the overall operating income, as you talked about before, here it is. This is the overall operating income of the company. Year on year is up 91%, which is crazy. That's kind of big, basically doubled, right? Basically
Yes.
double. But in terms of like the drivers, right, to address them or to talk about them, let's go to each segment. So let's start with the USA segment. I mean, the North America segment. So on the left side, we see the net sales. And then on the other side, we see the operating income. So net sales grew here by 9% year on year from quarter 2 2023 to quarter 2 2024. And also the operating income actually grew as well, which is really, really good. Grew by 58%, which is quite high comparing to how much the revenue grew. So if the revenue grew by 9%, you will expect the operating income to grow also by 9% maybe.
Yeah.
Exactly. But the thing here, in terms of like the drivers, is that what Amazon is seeing is that it's seeing like an increase in shopping frequency and also an increase in the spend of the Prime members. So people that have Prime subscription. For me, it just feels like everybody has it, but it's very addictive, to be honest, Paul. And beside that, they've been very cost efficient as well by having a better inventory placement. So basically what they are doing now is doing a lot more kind of consolidated shipping, and that's helping them kind of not just ship one box from somewhere to someone, but they are grouping stuff and just being better in kind of shipping those things. So I'm not sure whether you have anything to say here before I continue.
Yeah, I would say they are trying to improve efficiency as far as moving stuff around, I guess, shipping a product, and also their warehousing business that they do with some of Amazon partners who are third-party sellers. You have to remember that 50% of the people selling on Amazon from China, 50% of the sellers, third-party sellers that are on Amazon are from China. And to get a high delivery frequency compared to another competitor like Temu, Amazon has to allow these third-party sellers to store their product in the US so that they can be delivered in the most efficient and the quickest way possible. So this business, because Amazon charges all these partners or sellers for warehouse space, then it is definitely helping them to make more money.
Exactly. And it's funny how a lot of people underplay China. China is a very, very big player in even the in-house, like internally, like inside those big, American kind of companies.
Yeah.
Exactly. So one thing I wanted to say here is that the operating margin for Amazon in the US, meaning dividing the operating income by the revenue, that's around 6%. And this is actually not bad, because if you check the kind of benchmark of e-commerce businesses in terms of like the operating margin is usually around 4. The lowest is usually 4% to like up to 10%. So they are doing 6, which is not that bad. That's actually quite good. So moving on to the international segment, this is the disappointing part, because the revenue did grow a little bit, 7% year on year, but the operating income is not great. It did grow as well, because last year quarter 2 they lost like literally $1 billion here, but this time around they are making around 270 million, but still it's very, very little comparing to the revenue that they are making. So that's a little bit disappointing. In terms of like operating margin, this is 1%. So this is below the 4% that I mentioned before in terms of like the benchmark of the industry. That's not great.
Yeah, so we can definitely see a real softness. If we can't see the real softness in the US economy, we can see it in the international revenue that Amazon is generating. So definitely, if you look at countries like Europe, where Amazon has a big continent, like Europe, where Amazon has a big presence, you can see that the customer spending is softening over there.
Yeah. I mean, I would say also that, Amazon, in terms of like the presence of Amazon, is mainly in the Western world, right? And
Right.
the first bit is like in the US. And in US is like very consolidated. It's like one big country. While in Europe, everything is like broken down into many, many different countries. And in terms of like shipping stuff, it varies in countries. I know that in the UK, for example, to ship stuff is amazing. You get stuff like there are like few losses in terms of losing your thing via the post and stuff. But if you were to go to France, it is totally different because they call something the last mileage. So basically, the last mile that the product takes from, let's say, the sender to the buyer.
The customers.
Exactly. And in that last mileage, there is a lot of loss in terms of like product that get to, their buyer.
Yeah. We experience the same thing here in the US, where there is, most of the time there is something we refer to, these people are porch pirates on the porch. And this is also one of the reasons why Amazon made the investment into Blink and the Ring camera as well.
Makes sense.
Yeah, I think about five years ago, back in 2018, 2020.
Totally makes sense. So now let's jump into AWS. So AWS, as we said before, is just 18% of the revenue of the company, but year on year it grew by 19%. And in terms of their operating income is very, very big. I mean, it grew by 74%. And in terms of like operating margin is 36%. And if you were to compare this with like, let's say, a tech company, on average, tech companies make an operating income of 20 to 30%. So this is even above that, which is really, really good. And this is being driven by kind of AI. So they are saying this is the earning transcript. They say that this is driven by generative AI and non-generative AI workloads. My understanding of that is there's like a lot of kind of training going on where they kind of leverage the AI, but this is your sector. So if you want to jump in and kind of provide more details, that'll be great.
Yeah. So AI is, although a lot of people are thinking of AI as, when most people think of AI, most people are thinking generative AI. They are thinking ChatGPT and stuff like that. But that is actually just a very small part of AI. AI before LLMs was reinforcement learning, image recognition, machine learning, and other fields, language understanding. So these are different parts of AI that were actually on a growth cycle before LLM became like this kind of main thing that everybody's focusing on. But yeah, so AI has been machine learning and other stuff that people are using to run some kind of insight on their data. And Amazon has been playing a bigger game over there for a long time before LLMs. Now, with their investment in Claude and Anthropic, with the release of Llama 3.1 by Meta, Amazon is now offering all those LLM as well. So this is, and I've said this before, if you really, really want to play this AI game, the main people or the main companies that are going to kind of take advantage of this are not necessarily the small software companies, but it's going to be these hyperscalers. It's going to be the Microsoft Azure, the AWS, who are going to be the provider of platform that people can use to develop these smaller softwares. So ultimately, some of this money is going to run from the small software distributors to the big infrastructure providers like AWS and Azure. So here, Amazon is, regardless of what happened to AI, if the bubble pops, it doesn't really matter because they will always generate money from this.
Exactly. That's why kind of understanding. So I was saying that for the reasons that you kind of mentioned before, that's why for me, I think Amazon looks like quite a stable business and that has, a lot going for it. And there are two other things that I wanted to touch on. So the first one is their debt to equity ratio. And really, this is for this quarter is equal to 1.2. So it's basically taking their total liabilities and dividing it by their shareholder equity. And basically what this tells us is that for every $1 that the owners of Amazon invest, the company borrows $1.2. So 1.2 is their debt to equity ratio. So this is not that bad, because in terms of like the range, 0.5 debt to equity is like amazingly great. And companies that you find with that debt to equity, they are very rare. And 3.0 debt to equity is like the worst. So they are again somewhere not far from.
Yeah.
Exactly. So that's actually really, really good for them. And beside that, so basically that means that the company is not like heavily inclined on debt, or is not like heavily leveraged in terms of like debt. And the other thing as well that I wanted to touch on is the return on equity. So the return on equity ratio is actually also not bad, is around 19% for this quarter. And basically what this tells you is how effectively the company is using their shareholders' equity or shareholders' money to make money. And here again, the kind of benchmark is around like 15%. So theirs is 19%. And this is really good as well for the company. So in terms of like the company's fundamentals that we just discussed in terms of like the revenue, the margin, the debt to equity ratio, the return on equity, it sounds really, really good, which is great for the company.
Yeah. One thing you have to remember is that Amazon fired about 10,000 people a couple of quarters ago. And this is also reflecting in their margin and their operating income. So you have to consider that as well. So maybe next quarter, you might not see the same change. But there is something else that can help improve their quarter. Yes, there is a big capex expenditure that is going to happen due to AI infrastructure. But Amazon itself is investing in developing its own chip as well. So Amazon has done this playbook before with their Graviton chip, which is an ARM-based processor, which has a good performance compared to the x86 processor like the Intel Xeon chips for servers. And they've been able to save a lot of money, energy, and offer lower prices to customers based on that custom chip. They are trying to replicate the same thing on the AI side by developing an inference chip and a training chip. They are calling the training chip Trainium and the inference chip Inferentia. And those chips, once they are built, are going to reduce their spending on AI structure drastically. And think about it, one H100 is about $30,000 to $35,000. When you build this in-house, you're probably gonna bring that expenditure down to maybe 75%. So you have to think about that. And them being able to offer the lowest cost LLMs or any other AI workload, that is gonna attract more customer and probably gonna grow the AWS customer base even further. So those are the things I will be looking for. Me, in general, this stock is one I don't feel like is overvalued compared to the other stocks. And yeah, I think it's a very stable company. And if the macroeconomic element improve, this company is going to even do better compared to these numbers that we have here today.
Yeah, I think they are a very balanced business, right? Because I think they are not like amazingly great, but they just do a little bit of everything. So basically, if you think about how a company can grow, right, it's typically by acquisition or innovation, right? So they are doing a little bit of innovation, as what you just explained, and also they've been doing a lot of acquisition in the past, and they are actually quite aggressive as well on that side. So they are like a well balanced a company, and that's the fundamentals show as well. They are quite good. One thing that I wanted to touch on as well is in terms of like the market positioning as well. They are quite strong in terms of the industries in which they play in. I know that for kind of the retail or the kind of e-commerce driven market in which they operate, everybody knows Amazon, right? That's the one everybody uses. Right. A few years ago, eBay was trying to compete. Well, yeah, I haven't used eBay in ages. So they are really, really well positioned in terms of the market in which they operate in. And we know that Temu has been competing with them, but Temu is, we made a video about Temu. If you want to know more about Temu, go watch that video. But Temu is a really strange one, and Temu becoming like a huge company and overpassing Amazon is, I would say the US is not going to let it happen, basically. Yeah, I was going to say that in China, right, they will be competing with Alibaba and whatever, and maybe they will take over Alibaba, right? But in the US, yeah, that would be be quite difficult. And, the tariffs are there. The government can play with tariffs, and that's what they've been doing for the longest. So
Yeah, I look at it in a different way. For me, the reason why Temu is relatively slow in growth is because they don't have a warehousing offering in the US. So if they decide to actually invest in acquiring real estate and providing a warehousing for some of their partners from China, meaning that if you want to buy something, you can actually receive your product in 2 days instead of 2 weeks, then they can become a very serious competitor to Amazon. So that's the way I look at it. I don't know if they want to make that investment, but that's the only way.
Yeah, I think that will go against what their business model is. So basically, their business model, as we discussed before, is to be the middleman between the manufacturers and the buyers without having any infrastructure.
Right.
So they don't have, they have like literally zero infrastructure. And you remember we discussed that people were even struggling to find their headquarters and stuff. So yeah, if they decide to go against, that's highly unlikely. But yeah, just to conclude this, on my side, Amazon is a well-balanced business. If I get the opportunity, I will invest even more in it. And yeah, I would say everyone should invest in it, though this is not a financial advice for him.
Yeah, so again, Daniel said this is on financial advice. If you want to know more about Amazon, we have charlie.ai or askcharlie.ai software, which allows us to kind of analyze this financial report, like the quarterly financial report from Amazon and their earning calls. So most of this research was done through that, and we'll share the link in the description. Feel free to check it out. Sign up yourself to go and ask some questions to the financial reports, and let us know what you think.